Okay, welcome back to the Capital Market Day. The first part has been kind of a more normal investor presentation, even if the time spent has not really been normal. So I'm very happy to see all of you again, and potentially also a few new people on the webcast. The agenda we have today is that you won't get rid of me at once. So I will spend some time on a kind of total company view, and then leave the word to Dag Marius on the investment side, on Fredrik here on the reinsurance side, and finally UK. So we save UK at the end of the agenda to make sure that you are not leaving too early then. Many of you would like to have a deeper look into the UK type of agenda. So my agenda is the company kind of overall status and a special look at the historical to date reserves. Remember that the kind of historical to date reserves has not been a topic because of the grey silverfish. It was actually a topic we would like to discuss with you before the quarter three ended. Because in many quarterly presentations, I think it's too much focus on the quarterly level. So let's take a bigger view, a longer view, a higher view, and update you on how at least we view the reserves the last 10 years. Let's not spend time on the DNA of the company. We talked about it later on. This is kind of I won't obviously not walk through this again. But at the bottom of this kind of presentation here, you see a statement that we are a fast-growing company with a healthy combined ratio or a good combined ratio with an average return on equity size 21, even in an interest rate level, which has been historically low for a few years now. It would have been easier to deliver return on equity size 20 or higher if interest levels has been better. I guess you agree with me on that one. So hopefully going forward, we won't see the same situation like the 3 last years. But I wouldn't know, and let's wait and see. So the question is, how is the present status when it comes to cost leadership, quality leadership, growth, and other elements? So I talk a little bit about cost and quality and growth expectations here, but also I will obviously go deeper down after reserve walkthrough on other important elements in Protector. We are not spending the company resources at the moment on a bug. We do not. We spend resources on several other areas, which long-term is much more important than the kind of thing we have discussed for 25 minutes in the investor presentation. We are cost leader in the world. What's my expectation for the future? And then you should go here and see cost the real way, which is the company cost ratio, inclusive of claims handling costs, less commission. That's the real cost ratio of an insurance company. There are 2 companies in the Nordic market who delivers basically these kind of figures every quarter. It's the market leader, If, and it's Protector. The other ones do not. So it's a bit of a difficult situation to compare apple to apple our cost ratio towards the other ones. However, I have challenged analysts the last 5 years in Norway, Sweden, Denmark, Finland, UK, Germany, France, States, Canada, and other places in the world. Have you ever seen a company with a lower cost ratio? And I have never ever been challenged, okay? My prospect for future is better. We will reduce cost going forward. It's a pretty easy statement. It's not that easy to do, it's easy to say. But it's a fact, because it's happening when we speak. If you think about it, it's pretty obvious. We don't have critical mass in the UK. We have a cost ratio which is very high in UK at the moment. Henrik will update you on the figures. When volume doubles, cost ratio will go down rapidly because we have scalability. In many claims handling areas, we have not critical mass at the moment. When we reach critical mass, cost ratio will go down. In some areas, we have just received critical mass, and cost ratio is going down now as we speak. So pure logic says that this is true. While other companies struggling with cost ratios, not too many in the Nordic, they are very good on cost ratios in the Nordic market. It's one of the most efficient insurance markets in the world. So cost ratios in the Nordic market is very good. So they are good, the other ones as well, but they're not even close to Protector. So it's obviously easier for Protector to reduce cost ratio when growing compared with other ones who have zero growth. And basically, everyone has zero growth except Protector. So my guiding to you on cost going forward is that the distance we have towards the others will at minimum be kept. I think it will slightly improve the next 2 to 3 years. And please come back. And some of you have followed the company here, and even here, when it peaked up. I said at that time, don't worry, there are reasons why it will go down. And it has. So to predict cost ratios to Protector is pretty easy. We are cost leader in the world. We will keep or slightly improve. We are quality leader in all markets. We fight every day in order to stay at that position. It's challenging. It's a lot of work. We need to be better in order to deserve that position going forward. I'll come back with a couple of initiatives which might influence on the quality opinion on Protector going forward. We have been growing 20% a year. However, we have said now we will slow down in 2019. We will slow down in 2019. Profit is more important than growth. If you are getting closer to 100, we are either closer to 100 or 100 or above 100 at the moment, depending on how you view reserves and how you view segments and totality. So at the moment, combined ratio is too high, and that's not only grey silverfish or change of ownership. And I've been through that kind of story in the investor presentation here. So growth will not be 20% a year going forward. I will be a bit more precise later in the presentation on my expectation on that area. We have had and this is kind of, I'm sorry, it's not updated after Q3. So this is at the end of 2017. This is worse today. You saw it in the investor presentation. This is 3 quarters more, so give or take. So it's, they are not, I think they are, both are correct. I'm pretty sure both are correct, but there are 2 different time periods into that. Return on investment has been better than peers. Also, when you look into it, seen from a risk-adjusted point of view. And again, Dag Marius will talk more about investments in the Capital Market Day. Okay, so let's go to the historic to date reserves. This is lagging, so if someone with more technical skills than me could help, that would I would appreciate that, because it takes a few seconds every time I push the button. I hate to wait seconds. Okay, so here's the people who are the most important people when it comes to the reserving in Protector. Obviously, the actuary, the chief actuary here. We have external actuarial services because this is the kind of system we have in Norway. You have to have 2 parts involved in the process. It's the CFO. I've been working together with actors since late 80s. The chairman who is present now, He is a reserve expert, obviously, actuary with background and with 30 to 35 years of experience from insurance and reinsurance sector in that area. So I would say that probably have acceptably good people on this side. The question is whether we do the figures right in that area. So how do we do it? I would say we do it the traditional way. There's nothing on the page which is it's nothing special. Any company would give the same statement. There is one element which I could comment on, is that no discounting is implied on reserves. Some companies do, because they are allowed to, and they have a different accounting practice in their country. If you go to Denmark, you discount some of the products in the reserves, meaning that your claims ratio will be slightly lower. In previous years, where risk-free interest rate was higher, you could see a combined ratio Gjensidige in Norway compared with Top og Tryg in Denmark, that it was a significant difference because discounting happens in Denmark, not in Norway. However, today that difference is minimal. So it's close to zero because interest rate level is what they are in that area. But then, you know, because in Europe and in the States, it could be different practices and different ways of doing it. No discounting is done in the reserves here. But this is not special at all, it's normal. The process itself it's not special, it's normal. So the actuary have a direct reporting line to the board and to the FSA. That's normal. And the actuary talks to business, that's normal, and there are meetings. Because no model is perfect, and you have to combine model and prudent work with your figures with understanding what's happening in the business. I think all companies in the Nordic market have a pretty good type of dialogue between actuary and the business side. So no difference here. I think we are slightly closer to business now because we have an internal actuary. Some 3-4 years ago, we had an external actuary. Okay, both good, but one is sitting in the business, which normally is slightly better. Because you're closer to business, you understand what's going on. So that's good. Normal process. Is it difficult? Yes. It's not easy. Can you do it? Probably not. But some of you can, I know. So there are, I guess, 5 to 10 people in the room who are competent to do what we're talking about here. And you don't have to be an actuary in order to be good at it. But you have to be very, very good on figures. So things that influence on the complexity of the reserve setting is history. Are you old or young? The older you are, the easier, because you have more figures. What type of clients do you have? Commercial, slightly more difficult than consumer, because there is more volatility. Products, we have normal products. That's not an issue. We have 5 countries, that's also normal. So I would say same. However, we are growing 20% a year. The other ones are not growing. So when you grow fast, it's more difficult than if you don't grow. And if you grow fast in a new country, slightly more difficult. Okay, it's not a big issue. We do the same products in the same countries like most others, Nordic companies. So it's not an issue. Tail, we actually don't have that much long tail. So you think we have a hell of a lot of long tail. We do not. We are according to market, over market. So it's not a big issue, but you talk a lot about it. I would prefer to talk less, but there is an issue in that area. Business relationship, closer, process, talked about. Is it difficult? Yeah, okay. But I think we have competent people. They are committed. We have a good process. And the question is, what are the results? You might argue that with a company coming from zero, growing to something, which is us, go from 1, 2, 3, 4, 5 countries, it's pretty difficult to do the reserves right. Okay, so here is the jury. Is that we have historically to date, even after the bug arrived, a reserve gain, size exactly 147 million Norwegian kroner. There are a couple of analysts here who have done these kind of figures. Ulrik, I saw you. There you are. Okay. So Ulrik, for instance, did an analysis a couple of years ago where I think you concluded that reserves are prudent. Right, Ulrik? Okay. Say again?
I did not know about workers' comp.
But he is kind of saying, I didn't know about workers' comp in Denmark. But lucky you, that was not a big issue, was it? Because workers' comp in Denmark didn't really destroy your conclusion, did it? And he said no. Okay, thanks a lot. We didn't really prepare this dialogue in that era. But I know that if you are a competent analyst, you must find that answer because it's in the annual reports. So go back home and do the figures. You will find exactly the same figure. But we haven't released these kind of figures on a quarter-3 basis, so you can't do it today. But the conclusion is that on some products, we have gains, some losses, some gains, large gains, very large losses, some gains, and this is the estimated written premium 2019 on the different product areas. The list is too long. It should be 24. This is only, okay, so there are at least 2 here and 2 here. That's right. So it adds up to 24, which is good in that area. So what you see is that we have been prudent on reserves. There is one big reserve problem through history, and that's that one. So we have consistently been wrong. That's not good. There are many reasons why. And in the board meeting last evening, we discussed that very thoroughly because we had to. Because what we discussed yesterday was whether we should go out of change of ownership or not. So the chairman, the actuary, and the committee before the board meeting, and the actuary, and the board, and the CFO, and myself, and others, we were involved, obviously, in a research discussion in change of ownership yesterday, which is not a kind of a new discussion in that area. So, okay, that's not good. But all other products, commercial sector, 92% of business going forward, they have been on the prudent side. With a figure, give or take, I haven't really calculated it properly, give or take, 600 million on the right side, last 6 years in that area. So that's okay. So even if we have been mistaken here, and I do not blame the actuary, not the old one and not the new one, because how could he? This is not what an actuary could or should have seen. Gray silverfish, wow. Is it an actuarial problem? Not at all. When you have some figures and talk to the business, you take the losses in that area. So the results are pretty good. Questions to historical to date reserves? Yes?
I totally agree with you. This is very, very interesting information. So if we could have some help in finding the reserve releases per product in the reports, that would be very helpful. And also, I have struggled to find a separate line for the change of ownership insurance. So if you could also point us to where we could find the reserves and also the reserve strengthening or losses for that historically, that would be very helpful for us as analysts.
Okay, so you on the webcast here, I will repeat the questions and the comments. An analyst which has been following Protector for the last 10 years or something like that, Vegard, asking the questions. So first, I guess you said that this is very valuable and interesting information. Thanks a lot for the update. And he would like to see a more detailed walkthrough on the different business segments through history in order to understand more about it. And the feedback to that is that we will be slightly careful to release everything what you're asking for. We can discuss it a bit more after the meeting. But we should carefully consider your request for information when closing 2019 books. So we will obviously consider it. It's a pretty relevant and good question. But there are, as you know, reasons why we shouldn't be too open on anything and everything in that area. So we have to balance investor information with other discussions at the same time. Good question. We can discuss more. It's obviously more than what you see here in our annual reports. It's obviously more. Other questions? So, credible or not? I'm nodding. Huh? Oh, come on, nod a little bit now. There a new investor from the Netherlands there, smiling at least. He nodded, I saw you. So thanks for introducing yourself to me. And we have a Dutch-speaking person in our company as well. So is Leonard here, Lars Ola? No, okay, so yeah, apologize. You have to stay on English then. Okay, so what about the reserves going forward? They will be prudent. We have been good on 92, bad on 8. We will be prudent. Questions? Okay, thanks a lot. Any questions on the reserve side, Vibeke, from the webcast? No questions on the reserve side. Okay, so let's move on then. Let's have a company look going forward. Not talking about UK, not talking about reinsurance, not talking about investments. And obviously I will not go into details on other countries either, because when we go into details in Sweden, the country manager of Sweden will be here, or Denmark, the country manager will be there. So it will not be an in-depth presentation or walkthrough of the different business units. So this is more like a company story. And three subjects will be kind of on the agenda for the rest of the meeting. Here is the people. We are fit for fight. And Dag Marius, he says, I love what I do, even higher than Liverpool Football Club. Which is, okay. Henrik, you will have a presentation later on. I started Sweden and Denmark, finally something big. So Henrik, where are you? Okay, so finally, I look forward to listen to your presentation. Kind of, don't be too serious always. So let's have a little bit of fun, even if results in quarter 3 is not that good. So read through. Most of these people have been around for many, many years. So we have been a part of the history and the story, and some are new. So Lars Ola is pretty new, a year. Leonard is pretty new, a year. And Thomas, the new country manager in Denmark, is 14 months old in the company. But the other ones have a pretty long background from Protector. We are a rather young company, but okay, they've been there for a while. So what's our strategy? It starts with the DNA of the company, and it ends with the people. So when discussing strategy in Protector, it's culture and people. In between there is strategy. Culture and people is more important. Okay? Is more important. However, we need a strategy, and we don't like to change. If you change too often, it doesn't end good. Investments are core. Balance sheet is important. Profitability comes before growth, and claims handling. And top 8 is the 8 most important strategy products in Protector. Okay? So this is the perspective when we and the board of directors discuss strategy. So let's have a look at the 8. That is claims handling, profitable growth in Nordic, UK, return on investment, like Marius, peer knockout. And peers are not you. That's difficult, okay? Peers are the other insurance companies. I know we have an ambition to do better than everyone in the room as well, like Marius, but we hope you do extremely well. If you are better than other insurance companies, risk adjusted, we are happy. Protector University, I come back to it. IT, world-class headquarter, and management matrix organization perfectly. So this is the top kind of agenda for Protector going forward. And I talk about Falcon. Henrik will talk about UK. I have talked about profitable growth Nordic already. Dag Marius will talk about return on investments. Reinsurance is a part of the totality and important and will be covered. That has implications both for the Nordic and the UK market. Okay. So, so that's the slow-moving technical thing. Okay, so let's talk about the Falcon. So the Falcon is the symbol for improvements in claims handling. 40 to 45% of all people in Protector work in claims handling. It is the moment of truth. This is who we are. This is what we do. Whether it is a car accident, a personal injury, a workman's compensation claim, or Grenfell Tower. This is who we are. We should be good. The symbols here means clean desk, efficiency. The falconer is a symbol for efficiency. Rolls-Royce is for take care of your own money and the client's money. Recourse and reduce. RR, quality, Rolls-Royce. And perceived customer quality, and the robot here is kind of out there in the market and checking out quality every day. So here are the results on the most important strategy project we started 18 months ago in Protector and will continue basically forever, but with a reasonable focus at least at the end of 2020. It takes time. The Rolls-Royce level is 420 million versus target 375. We are not known as a company to set small targets. We are ahead. Clean desk, we are the most clean company in the Nordic market. We are not delayed in claims handling, and 20,042 out of 20,861 man days so far this year we have been clean. So the kind of figures you see here, you have never ever seen any insurance company update you on. Right? Hand in the air. You analysts that talk about claims handling with competitors. Have you ever seen it? No, you have not. How often can we see it? Every day. Do we have a management information system? Yes. Is it up and running? Yes. Can we have a look every day? Yes. Do we look every day? Yes. However, we didn't have a management information system sniffing out the gray silverfish. We have to figure out a better management information system then. Okay, I take that. But at least, clean desk, we are pretty good. Not pretty good, we are very good. Instant customer feedback. Wow. The robot tells us that the client is very, very happy. That's good. isn't it? When you increase prices, it's a good idea that claims handling is good. Because if claims handling is viewed as poor, you lose a hell of a lot of clients. If claims handling is looked upon as either prudent or good or very good, it helps because it matters for the client. And what matters for the client matters for the broker. So instant customer feedback is very good. We are 13.4%, I'm afraid, not percentage points, percent better this year. Sorry about that. Compared with last year. Okay, that's pretty good, isn't it? Why? Because finally we have put claims handling efficiency on the serious agenda. Because finally we have critical mass in many product areas in at least 3 countries. Obviously we are not even close to critical mass in the UK. So claims handling cost in the UK is obviously very, very high. And it will be next year as well. However, in 2020 it will not in that area. But now efficiency is 13.4 versus a target of 14.7. So we're behind target. I don't really care. It's about what it should be. So the Falcony project, the #1 strategy project in Protector, is doing very well. So I'm happy. So while struggling with a little bug or rate pressure in the Norwegian market the last 5 years, which has ended up in a combined ratio which is too high. Obviously, we do other investments and initiatives, and we train and educate people. We improve systems, and we release new systems 800 times a year in order to improve what we do. So the speed of innovation in Protector is pretty good. Sounds like a nice story. What we all are looking for is to see that transferred into figures. And my opinion is that, yes, it will. Yes, we are delivering poor figures now. Our history has been good. You will, in my opinion, see a good future as well. So we do other things than look at what was good or bad and the quarterly reserves or motor Norway or Sweden or whatever. We have a top picture. This is important. By Norwegian, okay, we have Ibsen, Henrik Ibsen, and others. You know, author Henrik Ibsen. But I won't say names on the kind of authors in Norway I don't like. But okay. Great at Work will start in February. And the opening speaker is one of the top managers from Hannover E, which Jostein, chairman and myself, had a dinner with in Monte Carlo a couple of months ago. He has never ever been in Norway. He has been a top manager in Hannover E, one of the biggest reinsurance companies in the world, for 20, 25, 30 years. He has been in business in 37 years, I guess. So he will be the opening speaker in February. And he should either go to London to do investor presentations like always, or be the opening speaker in our management training program. And he actually decided to go to Oslo, which is very good. So he has confirmed, we discussed it when we met him last Jostein. We invest a lot of money, time and resources in management development. And I look forward to Great at Work starting in February. We think we can do more developing our own people. I think that since we are quality leader in all markets, you could argue our people have the right attitude and good skills, and we train. But we train too little, so we must train more. And one way of training is to do e-learning, obviously. And we have been pretty bad on e-learning up until 2019. But when we decided to move around 9 months ago, we are moving quickly, as always. So today we have around 250 e-learning modules supporting new employees and people who have been here for a year or 3. And gradually this will be developed also to support some of the best people we have in Protector. So it's a project which has been up and running for 9 months. And the IT supplier of the tool here are giving the kind of feedback to Protector that they never ever have seen such a rapid development on such a quality level. So they would say, I've never ever seen anyone produce 25 modules in 6 months, never ever. And we are talking about big organizations buying a kind of tool here. So we move quickly when we decide to move, and the e-learning platform on Protector is improving a lot at the moment. The challenge is to get it closer to on-the-job kind of situation in that area. So we invest in more education and training in order to prepare for future. So my final comment to my kind of opening presentation is that together with struggling with short-term issues, which we will and shall, we obviously have eyes in the future, feet on the ground, and are trying to combine using resources, both short and long term in that area. So thanks a lot for your attention on the kind of opening session. I guess I've saved a couple of minutes of what we were behind because we were 10, 12 minutes late and now we are only 5. Is it any kind of questions to me before leaving the word to Dag Marius? And then there will be a break half an hour from now. Any questions? Okay, thanks a lot. An applaud to Dag Marius then. Okay?
Thank you. Sverre, first slide. This is our asset and management development the last 10 years. Rapidly growing company. This is 2.3 billion in equity, 1.25 billion in subordinated debt, and the rest is float, that is prepayments from customers. So it's about 10 billion now. And this is seasonality you can see in the last quarters there. We get the prepayments in the first quarter from Norway and Denmark, and in the second quarter from the UK. Another point to highlight here is the equity share that is down to 11.1%. That is not us being very smart, that we foresee the correction in the stock market the last weeks. It's just due to us not having good enough investment ideas on the equity side the last couple of years. Spoke a little bit about it last year also, that I didn't have any ideas. I got one suggestion, that was a good suggestion, we didn't take it. But more suggestions please. We have a low share now, and you can see that it's only in 2012 we had so low equity share of our portfolio. And on the bond side also, that we'll come into later on, it's more than 50% AAA rated bonds. This is due to the very low credit spreads, and the bond terms also are worsening. So then we are prudent, we'll wait for the opportunity. Hopefully the market will fall more, and it was a question earlier on today that I should answer. If the stock market correction of 10% made us invest more, and I would say that that's helpful, but we hope for more. We've been praying for this for so long, many times, but maybe we have an in on God now, so hopefully. Yeah, 1, 2 seconds late, yeah. You have already seen this, good results historically. This is due to some skill, some luck. the interest rate in Norway being 1% higher than in Sweden and Denmark the last 8 years. And some of our competitors are based in Sweden and Denmark. And also we have had a slightly higher market risk than peer average in the period. The investment process we went through in depth last year. We always try to improve it. We have made some changes the last year, and I'll come back to them. What I will talk most about today is our capital allocation, how we approach it in Protector. And this is our main alternatives. The main one, insurance underwriting. And then we have investments, mainly equities and bonds. We can do buybacks, and we have done it. We can pay back debt. We can give you back the money in dividends. But first, when we do this, we first have to determine our minimum hurdle rate. Then we have to individually calculate returns and risk on every alternative. Then we deploy the capital where we get the best returns that reaches our hurdle rate. We release underperforming capital, and then we repeat. So this is our target on the return of equity. And as you can see, we have reached it the last years. But when it comes to solvency capital, we don't only have the equity, so also have a subordinated debt. So 1/3 of our solvency capital is subordinated debt that we pay less than 5% for. So to get a return on equity of 20%, that equals a return on solvency capital of 15, just about 15%. So every insurance product have different or ties up different amounts of capital. So if you have a long tail product, it ties up a lot of capital, and then we need a low combined ratio for it to reach our hurdle rate. And a short tail product will tie up less capital. And we can also see that if the interest rate are increasing, that will help us. Then we can tolerate a higher combined ratio and still get the same returns. And overall, the insurance business has been very good. Almost all products have very high returns. And that's a bit challenged now, but the history has been very good. But one thing that I need to comment is that we have a target of above 150% solvency capital ratio. So when we look at how much we tie up in every insurance product, I have to multiply it by 1.5. Or else we won't reach the target. Looking at investments, that's been challenging the last years due to the low credit spreads and all-time high stock markets. This is a bit technical, but I think it's important for you to understand how we think about it. And it's very dynamic also, so it changes all the time. But we will never be forced sellers of our equities. That's so important. If we ever will be that, we have failed. Selling at the worst possible time, that's not a good idea. So we have to have enough capital. So we have to withstand that the financial crisis will come tomorrow or the next years. So that's what we plan for. So it ties up 50 to 60, it's better that I use this. 50 to 60% equities, a share price collapse of that magnitude. And if the stock markets fall that much, the use of our subordinated debt also falls. So that means that we have even less solvency capital that we can use, so it ties up even more. And the Norwegian FSA says that after a market crash of 50 to 60%, we have to prepare for another 29% fall. So that also ties up capital. But then again, the The equity market has already fallen 50% in that scenario, so that will only be 14.5%. And we have a positive diversification effect. So when we look at equities, we can only use, and the float for us is free, but we can only use like 20 to 30% when we invest in the stock market. But the tier 1, tier 2 capital is cheap, and we have to get a 20% return on the equities due to the return on equity target that we have. But when you translate this then, that means that every equity investment we do when the market is at all-time high levels, as it has been for the last 3 years, we have to at least get about 11% yearly return. That is a return on solvency capital of 15%, and that will translate into a return on equity of about 20%. But of course, our forecastability on the stock market is not that good, and every company, so we have to have a safety margin on that as well. So we have done some changes this year. Earlier on, now we have about 16% hurdle rate before we invest. Earlier on it was a bit lower, and we didn't think that was enough for us because we didn't have that foresight into the companies that we looked at. And the framework, when we look at on the bond side, is just the same. In the financial crisis in 2008, there was a severe spread widening all across the different rating classes as well. And this example on the high yield, the BB rated bond, it fell for a 2-year duration. The spread widened with about 1,000 basis points, meaning that the price decline was 20 to 25%. We have to hold that capital. But on the interest, we pay tax, so we get that back. And the same happens when we lose money on the bond side. We can use less of our subordinated debt that counts as solvency capital. And the Norwegian FSA, after a market crash, will still say that it can fall more, so we have to hold that capital as well, and we have positive diversification effects. And on this example then, a BB rated bond yielding 5%, we have to try to calculate the cost of risk. In this example is 2%. The cost of risk is the probability of default multiplied by the loss given default. And in this example, it yielded an expected return of 3%. If that ties up 20% solvency capital, it will return a return on solvency capital of 15%. That will transfer into a return on equity of 20%. So that's how we think about this. And if the spread levels increases, then we don't stress it that much. And it's probably a much better investment also. So this is the reason for us being kind of prudent the last years and taking down the risks. And now we really hope for more volatility. Buybacks, Sverre, that's your slide.
Okay, you can. So we kind of agree that that when it comes to buybacks, kind of my comment, not the chief investment officer. And I think that the story is pretty easy. We have a lot of capital ending Q2. So a very, very solid company. And we can see that the share price, in our opinion, is below intrinsic value. So why shouldn't we invest some of the excess capital we have in a buyback situation? At the same time, we have fewer investment ideas. And we are taking money off the table, both on the bond side and on the equity side. So we can kind of invest more in our own equities if we would like to. At the same time, we have a situation where we have profitability issues on the insurance underwriting side, and we can see that we will grow slower going forward. So the position in the company and in the board changed during quarter one and quarter two. We saw that the growth rate, everything else equal, going forward would be lower. So let's consider buyback, and then we decided. Some of you have asked whether we do buyback in order to protect the share price. Come on, we never do that. Why would we? We are long-term investors. We would never ever think to ID. That's too silly, isn't it? So at the moment we thought, and we still think, that it was a prudent investment to do with excess capital, expecting lower kind of growth going forward in that area. So it's that simple. It's that simple. Any questions to the buyback situation? You have all already asked the questions, whether we consider it now, not yesterday. We didn't have that on the agenda at all. So we did not, and I think you guessed the reason why in that area. So we didn't have it on the agenda. We did what we did during the summer. It's not on the agenda, and you shouldn't expect anything going forward in that area. Okay, thanks a lot.
So other alternatives for us, giving back the money to you. For us, it's might be easier, you might think, because we can, with the money, we can use the float as well to invest and then get a gearing effect. And we can pay back our subordinated debt, but that's cheap solvency capital for us, so that's not a good idea. Holding too much excess capital, that's a significant headwind for returns, so they're a problem for us. But then again, we rather be prudent, and we will not invest if investment don't reach our hurdle rates. This is an update on the equity portfolio. This is our large 10 largest holdings. And we say that we always look like 5 years ahead at least. And we had, at the end of quarter three, we had 15 companies in the portfolio. So it's a concentrated portfolio. So you should expect volatility in it. And with 15 companies, every year you should expect us to sell 3 companies and buy 3 companies. And we have sold 5, and that's a high turnover in the portfolio. And the problem is that in 3 of those companies, these 3, the investment case changed. So we had to do something. So we sold them. And when the investment case changed, we usually lose a lot of money. So we lost money in XXL and Olav Thon, but in Zooplus, the kind of the market disagrees with us. They still believe the investment case is intact. So that was a very profitable investment. In Dustin and Medistim, we reached our intrinsic value estimate, and then we exit the position. History to date, the results has been good, only 4 years, so too short period to evaluate, and a flattish development the last year. Some of the reason for the flattish development is this one. I will come back to it. But this is our optimistic approach to our investment today. So we believe that we will get 16% return on the 10 companies that you saw on the last slide, plus the 4 that we didn't show you. And that's optimistic. And given what has happened the year, we're not that good in forecasting. It doesn't look like that way. Because if this one is not balanced, if it's not 50-50, then we won't ever reach that return. So far this year, we had to downgrade an intrinsic value with more than 10% in 6 cases and only 1 upgrade. So that's not too good. So what do we do then? We expand the too hard pile. We have made investments that's probably too hard for us. We're not smart enough to invest in every company. You have to understand it and where the company is in 5 years at least. And we have obviously been too positive. It's a short time period, and hopefully it's better. And as I told you earlier on, we have increased our hurdle rate to have more margin of safety. And we're also not satisfied with not utilizing all the risk capital that we have. So we don't deliver on this point, we don't deliver on this point, and this one is seemingly good, but with our history now today, we downgrade more than we upgrade. So hopefully that will change. These are the companies, and when they're red, then we sell the position. One of them is Medistim that we've sold in October. And you can probably guess that 2 other ones are not on the top 10 list. Might be, I won't tell you. But some positive here is that we have done this for 3 years, and this is the highest number that we ever had. So we're more optimistic now on the portfolio. It's half the size that we want it to be, but we're more optimistic on the portfolio that we hold than we've ever been so far, and that's after these disappointments this year. On the bond side, we try to do the same comprehensive analysis. Won't have a lot of time going through this, but unless on the equity side, we also have to look at the bond terms. And that's very important before we invest. And some comments here when we take a stress rating, because we do our own analysis of what is the cost of risk. So in most high-yield cases we invest in, we feel that the spread levels is wrong. We believe it's too high, that the cost of risk is lower. But when we stress the company or the investment, if it's a BB rated bond, we stress it or expect it to behave like a BB rated fund if the financial crisis hits once more. We don't believe that the market will agree with us when the financial crisis will hit again. So if we believe it's a BBB rated fund and market says it's a BB, we'll expect it to behave like a BB rated fund. So we allocate capital, it ties up a lot more capital. So we don't do, we're not optimistic in that respect. We have a margin of safety. This is the development of the fixed income portfolio, about 9 billion, yield of 1.8%. Not that much. The interest duration is only 0.3 years. That's because in the Nordics there are floating rates in the bond market. And the credit duration is 2.3 years. And here we can see the change in the rating buckets. It's a very high increase in the AAA and tuned down the BBB portfolio. Because our analysis is that during a financial crisis, these companies will spread out a lot. And then it ties up a lot of capital in our books, and the returns are not good enough. That might change, and then we'll invest. This is we have a well-diversified portfolio, and this is the sector distribution. The comment here is that the largest part of the Norwegian high-yield market is oil services, and we have no oil services exposure. And the highest market share in the Swedish market is the real estate market, and we have a 2% position there. So we kind of doesn't mind what is the market cap of each sector. We do our own analysis and invest in what we think is the best. The performance has been good so far, but when you look at a bond portfolio, you have to look at it through a credit cycle, because it kind of, when the trouble hits, that's when we can see how good it is. And so far we have our outperformance has been during more volatile times. So that's what we expect in the future, but let's see. To sum up, investments are core in Protector. Historical to date return on investment has been good. And we have patience, we're willing to wait. We'll only invest if the investment is above our hurdle rates. Questions? Or is it later on? Or, yeah.
Questions?
Yep.
Fine.
Yeah, so the question on the yield of the bonds portfolio,
Yep.
how does that translate into return on equity or return on solvency capital? Because it maybe depends on how much capital.
Yeah, so you can say that.
Repeat the question.
Okay, yeah, that's how does the yield on the bond portfolio translate in the return on solvency capital and the return on equity? And if you have excess capital, we invested in AAA rated bonds. So that part kind of ties up, doesn't tie up a lot of capital, but we get a lot of excess capital that we don't get a return on. So it's, I can say to you that our investments that carries capital in the bond portfolio, they reaches our targets, or else we will sell them. But we have a lot of excess capital at the moment. We have a very strong balance sheet, and we're looking for investment opportunities, and that's dragging down the results. Yeah. Questions, Vibeke, from the web? For me?
It's more about the share buyback, but I don't know if we should do it later, maybe. It's more for Sverre.
Spørsmål på share buybacks.
So there's a question about share buyback. What kind of question?
So how do you define intrinsic value for Protector, and what would trigger a share buyback? Do you have any ratio in mind, sort of what Buffett had with Berkshire until the spring?
I think how do you define intrinsic value? Marius, you are more capable than to answer the question than me, and I think that pop that question to our IR department, and we send you some kind of information back instead of making a simple answer now. Is that okay, Marius? Was it another question, Vibeke, now?
The share part in 2009 was nearly 25%. How much share can you have, or equities can you have, so percentage of the portfolio?
Okay.
Okay, I can answer that one. That depends on how much risk we have in the bond portfolio and how much equity. So when we bought back shares, then we have less excess capital. And as Sverre told you, that was something that we appreciated because we have very much idle capital at the moment. Now we have a bit less, and but it depends. If you tie up a lot of capital in the bond portfolio, then we have less for equities. But normally it has been no problem for us to have 20% equity share. It might be higher, but then we have to take down on the bond side. And it depends on what we do on the buyback side and what kind of profits we get from the insurance business and the growth in the insurance business. So it varies all the time. Yeah.
Can you also, Marius, comment on the maximum equity position, which is the mandate given by the board?
Yeah, and that's 20%.
That could grow into
25.
if you have return on the kind of investment you have done in that area. So there's a mandate given by the board. However, at the moment, as Dag Marius says, we are taking money off the table, and today we are slightly lower on the equity side that compared with the end of the quarter. Slightly lower today compared with the end of the quarter. More questions, Vibeke?
Ownership related question. And that would be, what would you expect the combined ratio for this sector being going forward, and what will the other players do?
Okay, so the question is related to change of ownership. What's your expected combined ratio going forward? Obviously, as you have understood by the walkthrough with Dag Marius, we are looking into how much capital will that product consume. And obviously, we will walk away from that segment if we didn't think that the combined ratio delivers 20% return on equity. Exactly where that border is, that hurdle rate is, we will not comment on because we won't give that information away for the market, at least not at the moment. At least not at the moment. So, any other question? No, thank you. Hopefully, I hope you appreciate that the kind of that Darmarius leaves the value of Protector call open when walking through the investment philosophy of Protector, and we're not trying to hide bad stories either. So 1 out of 6 is on the right side. It's a pretty open statement, isn't it? So I think that again you seldomly see that kind of openness from other companies. Hope you appreciate it. Don't be afraid. We will continue to be open with you. And through that openness, hopefully then to build credibility. So now it's a break. It's half an hour. So 8:15, we will be back, possibly 5 minutes later. 10:15. So thanks a lot, and there is something to eat outside. Hello again. Welcome back to the rest of our capital market presentations. I would like to introduce now Fredrik Øyan, who is not only in charge of reinsurance in Protector, but has also held the position as a director in charge of property and casualty products in the company. And he is one out of the 2 people working now, setting up Protector in the UK market. His competences is not only on product or insurance, but also on risk management. And he's actually one of the very few people who many years ago educated himself as a risk manager at the university in London. So I think your English is slightly better than mine, Fredrik. So very welcome to
Thank you very much. Thank you. Yeah, it's gradually improving, this English of mine. So, as Sverre said, I'm a bit of an all-rounder, but my focus very much is on the reinsurance and particularly the UK P&C business at the moment. And perhaps by way of introduction, I should perhaps also mention I've been with Protector for the past 10 years. It's actually coming up to 10 years on the 2nd of November, so it's only a few days away. And together with Henrik and Sverre and many others, I participated quite a lot in our entry in Sweden and Denmark. And now primary focus is on the UK and the point that Henrik will touch on a bit later. Can you hear me okay in the back? Brilliant. A lot of thumbs up. That's great. So I thought when it comes to reinsurance, there are a few things that we'd like to touch on today. One is the purpose, sort of why and how we buy reinsurance. We'd like to take you on a bit of a journey as to where we come from in terms of reinsurance arrangements and sort of purchasing patterns, and where we are today. We thought we'd give you a bit of a current status of the treaties, look a little bit at the ratings of our reinsurers, and also try and shed a little bit of light on what the future holds. So please feel free to ask questions as we go along, and I'll try to be as clear as is possible. I think we'll start with the DNA and sort of our power of ideas. And when it comes to reinsurance, it's very much to do with relationships. So today we've got something like 44 reinsurers reinsuring different parts of our portfolio, with whom we've got long-standing and strong relationships. It's very much a mutual trusting relationship that we need to build on a number of programs, and some of the other programs we'll touch on a bit later are more like commodity. Some of the CAP programs, particularly on the employee benefit side. But relationships are key, and that's why we invest a lot of time and people in spending time in, whether it's Munich or Hanover or Cologne or London, and we travel around and we explain to people what we do on the direct side in order to generate that reciprocal trusting relationship. So I think that's quite important. And I think also what you'll see today on the coming slides, that we want to be very open with you in terms of the structures. We're going into detail as far as the various reinsurance structures are concerned. And please feel free to ask questions as we go along. I guess we all understand the purpose of reinsurance, but perhaps more to the tune of what we think about it. When we say why, it has to do with appropriate protection. That has to do with protection that really sits with the risk profiles that the different portfolios represent. And certainly it has to do with reducing volatility. It has to do with capping potential larger losses or looking at portfolio-wide, more proportional treaties as we've had historically. In other words, it functions as an alternative to capital. Historically, we've had proportional treaties, we've had excess of loss treaties, we've had alternative risk transfer structures, and we've had quota share treaties. And what you'll see later on today is a bit of a shift. I think touching on unique relationships has a lot to do with engagement. It has to do with a tremendous amount of meetings, but it all has to do with analysis and how well can we present our portfolio. How in detail can we analyze this and communicate that clearly to reinsurers? Make sure that we have 100% transparency in terms of the inherent exposure that sits in our portfolios, and how can we position that to get as favorable outcomes of renewal negotiations and reinsurance placements as we can. We also use a professional intermediary, in other words, a reinsurance broker, to broker all our existing placements, and we certainly draw value from that relationship. If we go back a few years, I've split this into a few epochs, as it were. And we go back to the very start in 2004, from our sort of cradle. Back then, which we could term the early days in Norway, we had an alternative risk transfer program, effectively smoothing out results, a quota share treaty across all products. We even had excess of loss protection. So we had a very, very low retention. We also had a rather low limit in terms of the type of risks we could write. And effectively, on an estimated maximum loss basis for property of about 150 million kroners. We'll touch on what these limits are a bit later today. Gradually, we are moving into 2007, 2010, where we've got a significant surplus treaty on the property side, and we've got excess of loss treaties covering employee benefits and casualty. And this is very much a continued growth. At this point in time, we're still solely in Norway, so geographical complexity or other product lines have not yet been introduced. Again, a very strong development and expansion in terms of capacity of the reinsurance program. But then something happens in 2009, and that is that we are not successful in renegotiating the renewal terms on the property surplus treaty. What then happens is that opens up space for another rather large reinsurer, mentioned earlier today, steps into that place and has effectively had that position, a strong position on our property surplus treaty over the past 8 years, since 2010. During that time, we expand to Sweden in 11, Denmark in 12, Finland and UK a few years later, thereby expanding our reinsurance programs. And it's not necessarily as straightforward, because what we require, particularly on the property side, but also on the UK casualty side, in order to function and operate and maneuver properly in the market, we require rather significant limits. But as we enter the UK market, we don't really have any business. So effectively, that trust that we'd built up in the Nordics was thankfully transferable to the UK, and that goes for really all the treaties that we have in place. There's also a solvency-based quota share structure in place, which we'll touch on a little bit later. But I think, as I mentioned, On the property side, we are expanding capacity quite significantly from 250 million to 800 million over this period. It's very much a gradual expansion. I think that's the word that needs emphasized. We feel at the moment that the treaties we have in place effectively facilitate the business we want to write and helps us maneuver as efficiently as we desire in the market. Now, if we look at 2019, and this will be the focus towards the end of the presentation, what we will have from the 1st of January 2019, instead of a property surplus treaty, we'll have a property risk and a property cat on excess of loss basis. In other words, a non-proportional structure, whereas we've historically had proportional structures on the property side. For all other products, that is to say employee benefits and casualty, both in the Nordics and in the UK, which are separate treaties due to the nature of the markets, are pretty much unchanged, but we'll have a very brief look at that. I think it's perhaps a little premature to speculate in what the future holds when it comes to reinsurance, but we are certainly discussing solutions associated with aggregate covers, possibly cross-class of business or cross-product line. And this is something we'll, again, engage with a few of our reinsurance partners in looking at what can be sensible solutions going forward. Okay, so that's a little bit of the backdrop. Now to the existing reinsurance structures. And please, again, raise your hand and ask if there are questions. I'm trying to illustrate this as simply as is possible. On the pillar to the right, we've effectively got our Nordic surplus treaties. They carry a capacity of 800 million, consisting of a treaty capacity of 775 and a retention of 25 million. In the UK, which is the pillar in the middle, is a very comparable and pretty much identical structure, just with a little bit higher capacity of 100 million within the treaty and up to 4 million retention. That's in pounds, so just, between 40 and 50 million kroners. So a little bit higher capacity and a little bit higher retention. On the very left, we've got our CAT treaty that covers natural catastrophes. And natural catastrophe as a peril is singled out or excluded in its entirety from our surplus treaty in Denmark. That's why we have to buy that separately. And on the CAT events, we would have a retention of 50 million kroners, Danish kroners, and with a significant capacity relative to the portfolio structure and portfolio profile our current portfolio represents. So I think already here you've got two different structures. The ones on the right are proportional in nature, and dependent on the size of an individual risk, we cede either more or less. So for the larger risks, we will have a greater degree of cession to the treaty. And for the smaller risk, we'll retain a greater share. So every single individual risk underwritten, forming part of our portfolio, will be ceded individually to these treaties. For both of those treaties, we have a facultative facility which sits quite effectively on top or above the treaty. And this facility is in place, it's pre-priced, and it's in place to cater for primarily individual buildings exceeding the treaty capacity. Like hospitals in Norway, like large town halls in the UK, like large warehouses in Sweden. So it's effectively a structure, a combination there of a treaty and a facultative facility which allows us to write risks with estimated maximum loss levels up to 2 billion kroners or 204 million pounds. So it's a rather big step from where we were back in 2007, I'll say 10 years ago, when we had under a quarter of a billion kroner in terms of what we could write. So that's developed, and very much a gradual development. Any questions to property? I'll go to the next one, because here we are illustrating how this program will change. So the proportional surplus treaty that we've had in place for a number of years, there are individual treaties in the individual markets that we find ourselves, has been a very good structure. It's been an excellent reinsurance contract from a commercial point of view and also from a capacity point of view. Now, over time, we have certainly discussed and evaluated and moved towards an excess of loss structure. Again, it follows a natural expansion of a rather vast portfolio that we currently hold, and will effectively allow us to retain more of the written premium, but also, consequently, retain more of the claims that will incur going forward. The new structure will have a capacity of 1 billion kroners, or 100 million pounds in the UK. The placement has been completed. So main treaty, as it were, our main property treaty covering all our property portfolios in all countries, including public segment, commercial segment, housing associations, all the Nordic countries and the UK, is in place. It was a placement that was completed 2 days ago. And that is a placement that will come into effect 1st of January 2019 with a 12-month duration. We are very pleased with both the markets participating on this treaty. We are pleased with the terms. And I think, again, we are very pleased that it's finally placed after having worked in preparatory mode for the past half a year, really. In addition to that, there will be a separate catastrophe excess of loss treaty in place, effectively very much along the same lines as the one currently in force.
Excuse me?
Yep.
Could you just give us an example of the different layers to the right there, layer 1, 2, and 3, how that works when you come to risk? If you could use maybe Grenfell Tower as an example?
Right, absolutely. So if we were to say that the property loss for Grenfell Tower, just for sake of argument, would take a round figure, so let's say 250 million kroners, effectively we would, on a single loss like that, a single large fire, we would retain the first 100 million kroners of a loss. The first layer, which is 100 excess 100, would be entirely exhausted. And it would go 50 million kroners into the second layer, so effectively exhaust the bottom part of the second layer.
So as I just understand it, 3 to 200, you will then be covered by the next 200, and then on top of that you will need to take some more on your own book. Is that correct?
No, so we will not sit anywhere higher up in the structure. We will only represent the retention of 100 million kroners. And layer 1, 2, and 3 are all placed to the tune of 100% with a group of 8 reinsurers, all of whom we have long-standing and existing relationships with, all of whom understand our book of business.
Would you typically take a syndicate in each of the layers, or would they cover different kind of parts of it?
So repeat the question, Fredrik.
Yeah, the question's related to the layer structure and whether certain reinsurers sit low down in the hierarchy or higher up. Typically for Nordic property, that is not the case. The reinsurers would tend to write an equal share across all layers. If you look to UK casualty, for instance, in other words, liability and motor, you will find very, very clear preferences where some reinsurers would prefer to attach at a much, much higher level. In other words, being far removed from the sort of normalized loss run, whereas others want to be much more hands-on and even take part in what you could almost deem to be attritional losses. the structure and the participation that we'll look at on the next slide when it comes to UK casualty, I haven't included who sits where, but again, it's much more fragmented structure. Yeah.
Thank you.
Yeah. Good, and we'll come back and touch on the property, I think. Say again? Oh, sorry. Yeah.
So how would this change the ceded level you have for property from 1st January? And also, is there any changes to the profitability of those ceded premiums?
Yeah. So I think, so 2 questions. How will this change our session level as at 1st of January? And will the profitability be expected to change going forward? Yes? Okay. So
You have a later slide on.
we do have a later slide. Yeah. Should we hold on to that? Yeah. Okay. Let's do that. It's a good question, of course. So I thought just to bring you up to speed as far as the current casualty in the Nordics and employee benefit structures are concerned. So here we've got 2 excess of loss programs. Both excess of loss programs cover operations in the Nordics. On the left, we've got Nordic Casualty, which effectively covers all classes of liability business, whether it's products liability, public liability, or financial lines related to PI, D&O, etc., directors and officers. All sorts of liability products are covered within this structure, as well as motor third-party liability. And the structure affords a capacity of 200 million kroners for all liability products and an unlimited cover for motor third-party liability, which of course is in line with what we offer on the direct side. This structure has been led by one reinsurer for the past 8 years, knows us well, followed the book for a long time, and has been a program characterized by relative stability, both in terms of our retention and over the past couple of years also in terms of the limits. When it comes to the employee benefits products, treaty rather, I think it's fair to categorize this very much as a catastrophe treaty. We carry a retention of 100 million, and the 400 excess of 100 million is catered for by the treaty. So this has to do with huge tragedies triggering either one or a combination of employee benefits products. Neither of these 2 programs have historically sustained any sizable losses. So the profitability to reinsurers in these 2 programs has just been very good. And of course, and as per normal, the reinstatement level, and I thought I just mentioned that, is between 2 and 4 reinstatements in the event of a claim, and it varies a little bit layer to layer.
Could you explain reinstatement?
Right, so if we have a loss which exceeds our retention and goes into a program and exhausts a certain share, a certain part of a program, for instance, if we have a loss of 60 million when it comes to a casualty claim, we will represent the first 20, and then the treaty reinsurers will pick up the subsequent 40 million. Upon that loss incurring, and upon that being advised to which we do immediately, to our treaty reinsurers, the capacity will not have been eroded, but it will have been reinstated. So it's an automatic reinstatement of the capacity exhausted within 1 or more layers.
You pay once more.
You effectively pay adjusted for the amount exhausted, not for the time remaining of the reinsurance treaty, or the amount of a layer exhausted, but again, at 100%. Yep.
So if you at the end of the year, on the Christmas Eve,
Yep.
have something and you want to reinstall it for
Yep.
the rest of the year,
Yep.
you have to pay whatever it is
Yep.
for that 6 days or 7 days.
To pay 100% of that cost of the layer, adjusted for the amount exhausted, and it only represents 4 or 5 days left of the year. That's what you do.
Okay, clear.
Yeah.
Would you take that risk on your own? Instead of having those 7 days insured?
There is an automatic structure associated with most reinstatement clauses. And in a way, it is to give something back to a reinsurer who has sustained a substantial loss.
You could, but normally it's priced very low. So normally you wouldn't. It's not prudent normally. You could, but you wouldn't.
Yeah. Right, okay. And lastly, this is the last slide in terms of the current structures. This is our UK casualty program. In the illustration on the left-hand side, we have liability. Again, employer's liability, public liability, products liability, and any liability extensions that we offer in either housing associations, public segment, or the commercial segment. That has a retention of £1.5 million. On the right-hand side, we've got motor, where we have considered it preferable from a commercial and pricing point of view to retain a little bit more exposure and have therefore a differentiated retention between the two product classes covered by the treaty. So our motor excess of loss retention is £3 million. The capacity within the treaty is £25 million, and we have a facultative facility which sits on top of the treaty, representing another £25 million. Again, motor in the UK is also on an unlimited basis. I thought I'd just mention a couple of things, because this is a rather new treaty. We was first placed 1st of March 2016, and the first renewal of the treaty was to take place shortly after Grenfell. Tragedy happened, and shortly after the Ogden discount rate, which is effectively related to an assessment of bodily injury claims and lump sum payouts. So we found ourselves in a very difficult environment. It's also a fact that UK casualty, and perhaps particularly UK motor, is not a reinsurance market that is sort of overflowing with capacity. It's a rather tight number of reinsurers willing and keen to write this type of business. So it's not as easy to maneuver as it would be, for instance, when it comes to Nordic casualty. So a challenging renewal, the first renewal, and we have now just completed on the 1st of September of this year, our second renewal for a 14-month period, taking us up to 31st of December of 2019. I think our view is the work put in by the team in order to prepare for this renewal has been phenomenal. The marketing efforts have been phenomenal. The result is a reinsurance rate, which is higher than we would hope for. It's certainly at a level where we can maneuver on the direct side in the UK casualty market, but we do expect going forward to see that reduce. It's absorbing or taking out too much of our gross written premium at the moment. But we're in early phases in the UK, and of course the portfolio, as the portfolio grows, we'd expect significant improvements there. The majority of the markets writing this, reinsurers that is, writing this treaty are also reinsurers that we've worked with for a number of years. But they are located in, typically in London, so they are not necessarily the people that we have the closest relationships with. We have with their organizations. But over the past 3 years, a lot of work has gone into forging those relationships, some of which are new. And just perhaps to instance the type of risk that we'd be looking to cover here. For instance, if we look at the ambulance trusts in the UK, consisting of 10,000 vehicles, that would be catered for by this treaty. If we look at large employers' liability programs for large retail chains in the UK, that would be covered by this treaty. So just to instance a couple. Just one word, really, or a couple of words on reinsurance ratings. Our panel sits between A- and AA-. And the average rating, if you weigh it by signed line, sits somewhere between A+ and AA-. So we have strong reinsurers with us. I've just instanced this through the various programs, so the excess loss cat, employee benefits, Nordic casualty, property surplus, and UK casualty. And on the very right-hand side, the composition from a rating point of view that our reinsurers for the property excess of loss program as at 1/1/19 holds. So as you see, there's a lot of sort of purple and pink, and to a lesser extent, A- rated companies. This is important to us, of course, something we monitor continuously, and will most certainly continue to do so. I thought also just to bring into play a couple of comments associated with the renewal 1/1/19, because as I mentioned, a lot of work on the analytical side goes into this, and we furnish reinsurers with a very substantial renewal submission. It's a huge document, and it's our way of explaining as thoroughly and in as much detail to reinsurers what our portfolio consists of and where we expect to go forward. So to instance a few, when it comes to the property submission, again, a very analytical and data-driven process, where we, if I were to list some of the sort of key takeouts, as it were, has to do with low exposure and low risk, has to do with a healthy property portfolio over time, having produced very, very good results. Our pricing being based on a highly significant database. So on the property side, we've got more than 80,000 billion kroners worth of insured values or exposure, to say another way. So that allows us to have a rather significant and rather high degree of clarity view on large loss loadings, large loss provisions, attritional losses for different types of trade. So it's valuable. Yeah. Strong results again, and a well-defined underwriting strategy. So this is what we provide, and then we have subsequent discussions, and it should arrive and has arrived with a very sound program for 2019. Similarly, on the UK casualty, slightly different angle, of course. We're looking at reduced risk and return to normal. I mean, early days when building a portfolio, the portfolio composition, you know, it's not necessarily as balanced as one would have liked. I mean, we can grow a little bit here and then perhaps a bit less there, but over time this will balance out. And so we are more in a normalized portfolio composition at the moment. Continued Nordic support, certainly, and a reduced risk profile, both in terms of the class of business and where we grow and what products, and also the, again, type of trade and vehicle compositions of our portfolios. So we say pricing is too high relative to portfolio, and we expect improved terms going forward. When it comes to the other two, I guess we've touched on this. Relative stability expected, no change to the lead reinsurer of either program, and as I mentioned, ample capacity in the market. So smaller programs and stable programs over time. One slide on to highlight a few faces, and I've been as humble as to include myself here as well. We work in sort of preparations for renewals very closely between risk engineers and underwriting. That is absolutely key, that collaboration. And it also includes when presenting to reinsurers, we always bring our best risk engineers and underwriters. So it's not just the analytical side, but it's very much the visual and visible part, which is represented not by a reinsurance department, but by the people actually writing the business and making the decisions. That is extremely well received. And of course, there is an element of negotiations where we've got, again, very hands-on involvement, both as a discussion partner throughout the process, but also in decision-making when it comes to the final placements of the programs. Right. Solvency-based reinsurance solution is in place. Yep. And covers all lines of business. This was actually gone through last year similarly. There is a minimum cession of 10% and a cession on a whole portfolio basis, which can increase up to 50% given a need for that. So effectively, it's a shock absorber and can provide also capital relief. Then I think this might be the last slide we've got. So just a couple of comments on the property side. With the change from surplus to an excess of loss structure, our net earned premium obviously will go up dramatically as we're not ceding to a surplus treaty anymore. Claims will go up in terms of claims volume. Commissions will evaporate. They don't exist from an excess of loss structure. And the net result, or the contribution that the property portfolio has when it comes to our operating profit or bottom line, is expected to increase. Now, a few figures on the right, but it's, as a final comment here, perhaps should mention that the surplus treaty is on a risks attaching basis. So every single risk in our portfolio that is either currently in force or renews or incepts between now and the new year will, for the duration of that policy period, be covered by the surplus treaty. And every account, every policy that incepts or renews from 1st of January onwards will be covered by our new excess of loss treaty. So this is, yeah.
We're open for a final question. Obviously, this is a kind of a rather thorough walkthrough of the reinsurance programs and changes, and we will be back after Q4, after full year result, and talk a bit more about the practical consequences, kind of the slide you saw before this one. Your question, Vegard. So there will be more quantitative feedback a quarter from now, but this is kind of a pre-update on what's happening entering 2019. Okay, thanks a lot to you, Fredrik.
Thank you.
We are not really running late because my summary is not really 15 minutes, it's more like 2 minutes. So it means that the next speaker, Henrik, will have his half an hour in order to go through the UK. And then let me introduce to you the kind of country manager in UK, also the person working very closely with myself and a very small group of other people, the key person setting up Sweden back in 2011, and setting up Denmark back in 2012. Like a few other people in Protector, he is also a sportsman. Also, his background is cross-country, like any Norwegian, you could say. Educated in the States. You are, as far as I remember, and do remember, you are the national champion for universities in the States. You have been celebrated in the White House. That was with one of the Bush presidents then, so welcome to Henrik.
Win cross-country competitions in the US is not that difficult. All right, UK. The flag we can skip, I guess, if this works. And not to tire you with this slide again, I think it is extremely important. The first question we got when we introduced the UK was, what's the biggest risk? The biggest risk in the UK is getting the wrong people on board and or not being able to align them to live our culture. And I think when we meet new employees in the UK, we say we are different. And this slide is not different. The words on it are not very different, but it is the fact that we spend a lot of time understanding it and then trying to live it. There are a couple of things that are different, and I'll get back to some of them when I speak about the people. One thing has to do with best-in-class decision-making, because in the UK, the hierarchy is stricter and stronger than what it is in Norway. And when we speak about best-in-class decision-making, that is not the management making decisions. It's about empowering people, making sure that everyone makes decisions. that's difficult for people who have experience from working in the insurance industry in the UK. So that's a big difference. The summary here is that we are on schedule in the UK. We've met some speed bumps. I've illustrated the speed bumps in the middle here. One is Grenfell, another one is reinsurance, and then we've had a financial rating requirement in one of our segments. Some of the speed bumps are related to market access. So the financial rating has been a requirement in the housing association market. So that means that we have not had access to all clients. Reinsurance has not really been a speed bump in terms of access to market. Fredrik mentioned it's a bit too expensive, which means that over time we believe that we will be able to be more competitive because we will have better reinsurance prices. Grenfell has more to do with something that reinsurance also is related to, and that is the capacity it takes to deal with a large claim and an event like Grenfell, and the fact that we need to present our portfolio, which is basically nothing in the UK, to reinsurers at the same time as we have one of the largest claims and you have a change in the Ogden discount rate. So, of course, it has to do with the capacity of key people working towards this market. And just to, I'll get back to this slide at the end, but and you have read it. But one thing that is extremely important for us to understand is that there is an order in our 4 main targets. Cost and quality leadership will lead to profitable growth. So those are our main competitive advantages. That's extremely important to get right first time. And then that will lead to a top 3 position. Okay. Grenfell first, an update there. Public sector is a segment that we know very well. We're the market leader in the Nordics. We have a very consistent way of doing our risk assessment in the segment. Municipalities or local authorities are fairly similar. So our job is to select the ones that are not bad out of all those similar clients. And in order to do that, we systemize a lot of information. So we systemize, obviously, claims history, exposure histories, but also publicly available statistics and our own inspections. So we have seen more than 12,500 properties or buildings in the public sector, Nordic and UK. We have systemized all the findings, all the pictures, and can benchmark one local authority or municipality against everything else on building class, on the standard of buildings, on deviations like waste containers placed outside the properties. So we have experience in the sector, and our key role is to find those details that separate these types of risks. And we believe that after doing that type of a risk assessment on Kensington and Chelsea, where Grenfell Tower is, we have done that. First of all, the first time we did it a very thorough way, because it is a large client in the new market. So we had more meetings, we did more inspections than what is normal. And secondly, we've done that underwriting at least 3 times now, because we had to do it again in order to see if we did something wrong. Then we did it again when we renewed the client, and we are still of the opinion that this risk is a good risk. They just happen to have Grenfell Tower. On 14th of June 2017, we established these 4 projects. We've been through them before, you've seen it before, in order to focus our efforts in or after the Grenfell tragedy. And one of the issues was to find out what is our role in such a tragic event. And that is for 2 reasons. One is in the communication externally and internally, but another one is to prioritize where we spend our time. And this has so many aspects to it. There's a public inquiry involving all types of experts from around the world following this event. And we're just an insurance company who happen to insure that risk. So what do we do? Should we be involved in all different parts of this? Or should we find out what we are good at and where we need to do something? And that's what we've done, and we've formulated some sentences around it where correct settlements, it's not to the injured parties. It's not about, it's about doing the correct claims handling, not about settling with too high figure or a too low figure, but what's correct. So understand what we're doing, professional claims handling. And then there are other events similar to this where the total payments from the event have been 70 to 80% to third party, mostly lawyers, and not to the injured parties. So the challenger, that's who we are. And how do we deal with that challenge? That is to work with the broker and the client in order to set up schemes where we can minimize those payments to the third parties and make sure that the injured parties get most of it. So I'll get a little bit back to it. And lastly, has to do with risk management and understanding what went wrong in the Grenfell situation. So learn and then contribute in preventing this from happening again. And that is also about being open towards our competitors, for instance, and everyone. So we're not hiding findings that we make in this process. We will share it. Sverre spoke about the property claim, which is settled, so it's good to have that behind us. The liability is obviously far away from settled, and liability is not concluded at all. But a couple of the actions that we've done together with the client and the broker in order to minimize payments to third parties is to set up schemes. For example, a rehabilitation program for the survivors, where instead of having 600 lawyers for 600 people, there is one person making a decision that everyone trusts, made a bit simple, and that should make sure that that money goes to the injured parties and not the lawyers. There is, since liability is not established, there's obviously opportunities here for recovery. We are, at the moment, together with our reinsurers, paying out money without prejudice, so without the liability being established. But we will meet with potential liable parties in order to see if it is possible to get a solution there. And that is also a way of avoiding too much lawyer costs. We've had feedback from the insurance chief of insurance from Kensington and Chelsea, and CEO for the broker in this case. Very good feedback after the property claim has been settled. So we're satisfied with that, and it gives us time to work with the liability claim going forward. This is about sharing risk management reports. So we have a report about 40 pages where we go through in a simple way the claims handling process, but spend a lot of time on our findings from inspections of 400 tower blocks in the UK. And we also put this in a context with the 12,500 other properties that we have seen in public sector. So I think that this document is should be interesting for players in the UK public sector, so the local authorities, the brokers, and our competitors. And it should also be interesting for the Nordic countries. We can learn something from this. So this is some examples of what we've done on the risk management side. We have categorized all the tower blocks in our portfolio, all the tower blocks we have in our databases, and we've made assessments of those tower blocks and are starting to understand how we can register using an online tool where the people on the ground can log information so that we can collect information about the fire security in these properties, and then we can share it with relevant parties later on. And then I just wanted to mention that when it comes to people in the UK, we have the biggest risk management team in the whole company is in the UK. And they are important in many ways, not only when we have an incident like Grenfell, but when we look at new risks, they're an active part and an important part of our risk assessment process. They are also very often the most credible party when we meet the broker and the client. And they are extremely important in making the risks better, which is the normal way of looking at risk management. So improving the risks that we already have on board. A transportation fleet who is poor at registering claims and learning from the mistakes they do, or is poor at understanding what kind of training their drivers need. That's a client that we can take on board and actually believe that we can improve. Okay, when we started a UK analysis, we knew the market was big, and now we have, with the help from the same consultant that we used in our initial analysis, some more figures on how large the market in scope for us in the UK is. So I'll go quickly through these. You have the, sorry. So basically, by looking at the total market, we see £10 billion as in scope for us. If you adjust for the broked part, then that figure is 8 billion. The largest brokers, the national brokers, they have by far the biggest share, but if you multiply these percentages with the market size here, you understand that they're also the smaller regional brokers could be much bigger than any broker in the Nordic market. So we need to look into also some of the other brokers here. They're very large companies, very large brokers. They could fit our culture and way of working even better than some of the larger ones, but we don't know yet. So there's a job to do in order to find out where to go. Geographically, we need to understand how the UK market works. All these geographical circles, they are more than big enough for us to establish an office. Question is more, when do we establish an office? We are in this region with the Manchester office now. London will be the next, and that will happen in the beginning of 2019. We need to be in London. We probably need to be other places because the competitive situation shows us that the larger companies, they are located in the different location, and that means that the brokers in those regions, they have access to a big market, so they don't need to go to Manchester or to London in order to find insurance companies. So we will then be basically outside their scope. Therefore, we will have to look into establishing in other parts of the UK as well. And when we entered the UK, or before we entered the UK, what people said was it's a very big market, and we understand that, and now we know a bit more. They also said it's highly competitive and very different from the Nordic market. But what you see here is that the larger players in the market, they have a large share of the market, and that is better for us. It's we can challenge the big ones just like we have done in the Nordic markets. Okay, then over to the team. So here's some pictures. That's the team now. Some of them are so new we don't have pictures. And I think an important element here is I started out with saying that best-in-class decision-making is different than what they are used to. So our understanding of that phrase. Another important element for us is that all business is local business. And you see that there are some faces that all of these are Norwegian faces in the middle here. It's probably a poor way of illustrating it, but we're not sitting on top of the UK team. It is not controlling the UK team. They know what they're doing. Many of these people have been 30, 35 years in the market. And of course they know what they're doing in terms of insurance. But what our job is to support that team with our strengths where they are weak. In some ways, for the more experienced people here, it has to do with structure and analytical capacity. And that's something we have from Norway and we can support with. But most importantly, it has to do with helping this team understand our culture and make sure that we live that every day. So we have an experienced team. We're starting to cover all the key roles. And then we fill up with capacity of highly educated graduates who do well on our tests and are committed to living our culture. People are obviously important in the perceived quality, and you've seen this result before. It is our broker survey from 2017, where we received very good feedback, but this is early. We did not have a lot of time to make mistakes at this time, but at least the brokers believe that we will deliver quality when we sent out this survey. And we are probably today sending out the survey for this year. So it's very exciting to see what the brokers think after we've had one more year of operations. I think the ambition of ending up at the same nominal score as 2017 is very high. But the most important element about these surveys is that it is a great basis for discussions with the brokers on where to improve. So to prioritize either strong sides of Protector, continue being good, or where we have done something poorly and need to improve. So it's a very good basis for those discussions. It's between 60 and 80 questions, depending on how you define a question. Okay. Segments. Just go quickly through a status on the different segments here. So starting out with public sector where we started, we have communicated previously that we had a poor 1st of April, which is by far the biggest renewal date in this segment. And the main reason for not winning a lot of this volume had to do with price. So we were too high. in many cases a lot too high compared to our competitors. And then the question is, well, if you could do it again, would you go down and win it? And the answer is yes and no. So mostly yes. If we knew where the market was, we could have gone there. So we believed in the opportunity for very high margins. We didn't understand where the market was. In some cases, we, right or wrong, think that the market is pricing the risks too low. For instance, on some liability products. So we have 80 public sector clients in the portfolio spread in the green areas here, and a consistent way of selecting risks. And I don't think we should be in a hurry to win volume in this segment. That will happen. So this is a big market. The clients are out for tender every 4 or 5 years. They're in deals and they have to tender because of public procurement. So we will see the market. And when we get the clients on board, it's not really that important. So that's public sector. Commercial sector, that's where the real potential is. And we are gaining traction. The way we gain traction is to be out with the brokers, get to know them, or use existing relationships from our employees in Manchester. And we've seen 500 tenders, only 60% quoted. In the Nordic countries, we are more at 80–85% of what we see, quotation rate. And the reason is that we have not clarified our risk appetite in a good enough way with the brokers. They're testing us to a certain extent, so they send us what we see as poor risks, and then we say no. So it's a process of learning, them understanding who we are, and we understanding who they are. We're a bit careful on the liability side, because we don't have enough data to understand where this ends. So we're a bit on the cautious side when it comes to liability. A lot of the volume is on the motor side, and I think it's a simple reason for it. It has to do with cost leadership. So on the motor side, with frequency of claims, that's where cost advantage is most important. The brokers understand that, clients understand that, and when we say that you cannot find someone who will give you a better price over time than us, then they believe us, because they see that we have a large cost advantage, and it is the truth. So, but we are increasing the inbox for property and liability. 10 broker houses right now that are in focus, but only some geographical locations from them, naturally around us in Manchester. And we are in the process of systemizing all the brokers, not only offices, but also names, their portfolios, and finding out where to focus our efforts going forward in the market. And then the last segment is housing associations. It's as, or like motor, a home turf area for Protector. Its cost advantage is extremely important. It's a data-driven risk assessment, lots of data. These clients have very low deductibles, so we see a lot of claims, and the relative share of large loss provisions is small compared to a lot of other segments. So volatility is smaller, and we have a good relationship with the broker. So we've had some, as mentioned in the beginning, some speed bumps, especially on the rating side. So some of these housing associations, fairly small. It could be 500 units in a housing association. They require A rating from their insurer. But Kensington and Chelsea and large local authorities, they don't require A rating. So it is about to disappear, and we've had a lot of engagement with the people in the market here in order to make that happen. So in summary, it's on schedule. 2018 has been some positives. I'd say the biggest positive is that we're gaining traction in commercial sector, and some negatives on the volume side, on the growth side. And you've seen this, so the estimates, it's a bit difficult to estimate something when the opportunities are so big. But these are our best estimates at the moment. And to comment a little bit on costs and the key figures here. A little bit. Cost is high in the beginning. We have not reached critical mass. And so around 20% in 18. 20 is when we believe we will reach critical mass. Fredrik spoke about the reinsurance, so you'll see that on the net figures that it is expensive. And then on the loss ratio side, has to do with reinsurance and the fact that we have some clients with high deductible levels. So claims will be volatile with a small portfolio. And that's the summary.
Questions to Henrik? No question? Everything is okay?
Maybe you can comment on specific niches within the segments in which you are strong. So you mentioned motor, given the high claims, but maybe on the liability side, on the property side, are there certain niches that you are particularly strong?
Yeah, I mean, I think could be a long comment, but in general, we target a broad part of the market. Remember, one of our targets is top 3, and in order to find where to go, we need to understand what's out there, and we are in the process of understanding what the brokers have and what our risk appetite should be. So it's not a clear answer to it, other than that the housing sector is a good segment, public sector is a good segment, and motor is easy to say that is a good general segment for us.
There's one more question, then
How
draw the line.
many employees have you got in the UK?
35.
35 employees. Okay, thanks a lot to Henrik. My summary is rather short. I think it's fair to say, if you compare Protector with Nordic companies, we are different. And the first statement from Protector, which is very different from any other Nordic player, is that we consider insurance and investment to be core business, both of them. While most competitors, or basically all, say we do insurance. So I think you should more compare Protector with other players in the world with the same 2 statements. Investment and insurance is what we do. If you believe in that, that leads to a second statement. Growth is good, as long as your combined ratio is healthy or good. The 2 most successful insurance companies in the world, the last 30 to 50 years, is probably Berkshire Hathaway and Michael. And that's kind of more companies which we would like to look at, not really the Nordic competitors. Not saying anything wrong about the Nordic competitors. They're very good at what they do. They are good. But they have a different approach, which is not bad. It's different. But our approach is an alternative. Insurance and investment is core business. That means growth is good. If you can manage that with an acceptable profitability, then you will create a lot of value going forward. Remember, our history so far is cost and quality leader has led to profitable growth. We have demonstrated the last 10 years a combined ratio size 93, which in this kind of perspective is good. And we have delivered return on investment, which is good, and return on equity size 21. Every insurance company, also Berkshire Hathaway, Warren Buffett, his company, and Geico, the daughter company of Berkshire Hathaway, and Markel, they have, through their history, have a look, they have met years where they have been unprofitable on a technical level. Go through history and see. It will happen. Even with Berkshire Hathaway, Geico, or with Markel or with Protector. This is our first year where combined ratio is above 100. Apologize for the poor result of this year. We will be back. And the strategy remains. And if I may add at the end of this walkthrough, we are a bit ahead of Berkshire Hathaway and Markel after 14 years. So thanks a lot for your attention and for spending either 3 or 4 hours together with us today. We are kind of 2 minutes after schedule. We won't take any more questions now. So thanks a lot and have a nice evening. After